Welcome back to the deep dive. This is where we take a whole stack of sources, articles, research, our own note, and really try to pull out the most important bits of knowledge or insight for you.
Yeah, think of it like your shortcut, basically, to getting genuinely well-informed. We try to dig up those surprising facts, maybe add a bit of context, just enough to keep you hooked.
Exactly. And today we're plunging into, well, the often turbulent, but I think always fascinating waters of high dividend stocks within the set time market.
Mm.
It's a space that's been generating really a tremendous amount of buzz lately, especially, given all the recent twists and turns in both global and local market dynamics.
Absolutely.
So our mission today really is to try and unearth answers to some, I think, pretty pressing questions, like which stocks are actually paying those attractive high dividends right now?
Right.
And maybe even more importantly, are these payouts truly safe? Are they backed by solid, enduring fundamentals, or are they just sort of fleeting opportunities in a volatile landscape?
That's the million-dollar question, isn't it?
It really is. And we're going to be zeroing in on two specific companies that have caught a lot of attention in this arena. AI, which is Asian Insulators, and its subsidiary, AIE, AI Energy.
Okay.
Our journey today will take us through their latest financial performances. We'll delve into their core business strategies, scrutinize their dividend payout trends, looking for sustainability, and critically, identify the crucial risks you really need to be aware of.
And this is exactly why a deep dive like this is so valuable for you listening. We're aiming to provide a genuine shortcut to being well-informed, helping you navigate what can feel like a sea of data without getting, totally overwhelmed.
Yeah, information overload is real.
It is. And what's truly fascinating here, I think, is how we can connect the broader sort of macroeconomic market trends to the very specific nuances of individual companies. This connection is just absolutely vital, particularly if your goal is to identify sources of sustainable income from your investments. It's not just about seeing a high dividend yield pop up on a screen.
Right, there's more to it.
So much more. It's about understanding the underlying story, the engine that's actually powering that payout, and asking, is that engine robust enough for the long haul? We really need to look beyond those surface numbers and truly understand the why behind them.
Okay, so with that broader context in mind, let's drill down now into the current landscape of the set time market itself. It'll be crucial, I think, to see how the overall environment is influencing investment decisions, especially for people looking at these income-generating assets.
Definitely.
What's been happening with the set index, and why are investors, seemingly flocking towards these dividend plays right now?
Well, the macro environment isn't just like a backdrop. It's really the ground we're standing on when we look at these stocks. And the set index, well, it's really taken a beating recently.
Yeah, I've seen the headlines.
It's positioned as one of the worst performers globally, actually, in the first half of 2025.
Wow.
To put that into perspective for you, it declined a significant 22% year to date.
22%.
Yep. And that stands in really stark contrast to global benchmarks like the MSCI World Index, which saw gains of about 8%, and the MSCI Asia ex-Japan Index, which was up a solid 14% over that same period.
Big difference.
Huge difference. And more specifically, if we look at May 2025, the asset index fell 4.0% just month over month, closing around 11,149.18 points. Its year-to-date decrease at that point was 17.9%. So this downward trajectory, it clearly reflects a market that's grappling with some considerable uncertainties.
That's a stark contrast, as you said, to global trends. So what are these core uncertainties then? What's dampening investor sentiment so much in Thailand? Is it mainly domestic stuff, or are global pressures playing a bigger role here?
It's really a potent combination of both, and that's creating this mix of caution for investors.
Right.
Domestically, Thailand has been facing some pretty persistent political instability. We saw the suspension of the prime minister by the Constitutional Court not long ago. Now, the initial impact on investor confidence from that specific event was, well, perhaps surprisingly minimal. Largely because the cabinet remained functional, government operations continued without immediate paralysis.
Okay, so day-to-day it kept going.
Exactly. But a more pressing concern kind of emerged shortly after that, and that was the withdrawal of the Bumjatai Party.
Yes, the second largest coalition partner.
Precisely.
Yeah.
And that move significantly reduced the government's parliamentary support down to just 261 out of 495 MPs.
So a much slimmer majority.
Much slimmer. And for you, the listener, what this means is the government now operates with this very thin cushion, making the passage of crucial legislation, most notably the upcoming 2026 budget bill, a very real and potentially major challenge.
And when is that budget bill due?
That bill is slated for parliamentary debate in early July, so right around now. And its successful passage is obviously vital for economic planning and, crucially, investor confidence. But beyond that immediate concern, the political landscape is still, pretty fraught with other risks. We've got an upcoming constitutional court ruling on the premier's qualifications. There's the constant threat of potential no-confidence motions, ongoing legal proceedings against former leaders, and even the possibility of escalating public protests picking up again in the third quarter.
Mm-hmm.
So these factors taken together, they create this palpable risk of policy vacuums or maybe just further market jitters down the line, which can really affect long-term business and investment decisions.
So plenty of moving parts on the domestic front, creating that sort of sense of unease. What about the external pressures you mentioned? Are global trade tensions still a major factor, and how might they specifically impact Thailand?
Oh, absolutely. External factors are definitely adding another significant layer of complexity here. We're looking at early July now, which marks the end of that 90-day grace period imposed by U.S. President Donald Trump for negotiations on his announced reciprocal tariffs on several trading partners.
Right, the tariff situation.
Exactly. Now, an extension of this deadline is certainly possible, but the absence of finalized trade agreements could cast a pretty significant shadow over global consumption and investment sentiment.
Okay.
Think of it like a cloud of uncertainty just hanging over global supply chains and consumer confidence.
Yeah.
And this, in turn, directly increases the risk of a global economic slowdown, particularly looking towards the second half of 2025.
Right.
So when you combine these domestic political issues and these external trade pressures, there's a tangible concern. And we've seen warnings from institutions like Tisco Securities, for example, that Thailand itself could potentially enter a technical recession in the second half of 2025.
A technical recession. Wow.
Yeah, it really highlights the severity and just the interconnectedness of these combined headwinds.
Okay, so given all these uncertainties, both internal and external, how are analysts advising investors to position themselves in the Thai market? What's the sort of recommended play here for someone trying to navigate this turbulence?
Well, with this elevated uncertainty, the general consensus among analysts seems to be, first off, lower your growth expectations for the Thai equity market.
Mm-hmm.
Tisco Securities, for instance, they've downgraded their year-end set index target for 2025 down to 1,208 points. That's from 1,337 before.
Okay.
And their 2026 target down to 12,279 points for 1,405. So significant downgrades.
Yeah.
Their core recommendation under these conditions is really to focus on two key areas. First, second quarter earnings winners, so companies showing resilience and growth despite everything.
Right.
And crucially for our discussion today, high dividend stocks.
Ah, okay.
These are generally expected to outperform in this kind of environment, maybe particularly in July, providing a more defensive and potentially stable investment avenue. It's seen as a prudent strategy, really emphasizing portfolio diversification across different business sectors to try and mitigate risk during these uncertain times. It's about finding those relative safe havens,
That makes a lot of strategic sense. High dividend stocks basically offer a form of immediate return, right? Especially in a market where capital appreciation might be harder to come by.
Exactly.
So how does the Thai equity market's projected dividend yield actually compare to the rest of Asia? Is that what's making it particularly attractive right now?
That's a really important point to underscore. The Thai equity market definitely stands out in terms of its dividend attractiveness at the moment. It's projected to offer a 2025 dividend yield of around 4.8%.
4.8%.
Yep. And this is significantly higher than the Asian stock market average, which stood at about 3.34% at the end of May 2025.
Okay, quite a premium.
It is. This yield differential makes the Thai market quite appealing to income-seeking investors, provided, of course, that those key risk factors we just talked about begin to ease or are seen as manageable.
Sure.
Now, there's another interesting dynamic here related to foreign investor sentiment. Foreign investors have actually continued their net selling trend, selling about THB 16.18 billion worth in May alone. Now, this was largely attributed to MSCI rebalancing.
Okay, explain that quickly for our listeners.
Sure. So MSCI rebalancing is essentially a semi-annual adjustment by MSCI, the global index provider. It often triggers massive rule-based buying or selling by passive funds, ETFs and index funds that track these indices. And crucially, this happens often irrespective of a stock's underlying fundamentals.
So technical selling, not necessarily fundamental?
Exactly. It suggests that while the selling was significant, it might not be a true reflection of deteriorating Thai fundamentals, but rather just a technical market event. And what's key here is that foreign ownership in Thai equities has consequently fallen to a relatively low 24.2%.
Interesting.
This suggests that if sentiment were to improve, perhaps as some of these political or economic clouds lift, there could be significant upside potential just from renewed foreign inflows buying back in. That adds another layer of potential attractiveness to the market down the line. So yeah, while there are significant challenges, that high dividend yield does offer a compelling reason to look at specific opportunities within the asset.
Right. So we've painted this picture of a, let's say, turbulent Thai market, which is understandably pushing investors towards these income-generating assets. But, theory is one thing, individual company performance is quite another.
Always.
How does a company like AI Energy or AIE actually navigate and, more importantly, thrive within this challenging environment? What do their latest financial reports actually reveal about their performance in fiscal year 2025?
Well, AIE has certainly shown some really remarkable performance in fiscal year 2025, which, as we'll see, directly underpins its recent dividend announcement.
Okay.
Let's break down the story those numbers tell. While their sales and service revenue for the full year 2025 was, interestingly, relatively flat, it only increased by about 0.22% to THB 8.2 billion. Roughly, their profitability metrics just absolutely soared.
Really? Flat revenue, but soaring profit.
Exactly. So for the fourth quarter of 2025, AIE reported a net profit of THB 147.59 million. Now, this is a truly significant increase. It's up THB 103.47 million, or a staggering 234.50% compared to the THB 44.12 million profit they posted in Q4 of 2024.
Wow, 234% year-on-year for the quarter.
Yep. And we look at it sequentially compared to Q3 2025, the net profit surged by THB 116.42 million, which is an impressive 373.50% jump from the THB 31.17 million in Q3.
Okay, those quarterly leaps are stunning, but, the cynic in me wonders if that's maybe a one-off anomaly, or is it truly indicative of a sustainable trend? What underlying factors could have contributed to that surge, and how confident can we be that those factors will persist, for the full fiscal year and beyond?
That's precisely the right question to ask. And the full year 2025 performance for AIE suggests it's probably not just a one-off flash in the pan. Their net profit for the entire fiscal year came in at THB 241.92 million. Now, this represents a substantial increase of THB 201.66 million, which translates to a phenomenal 500.80% growth compared to their full year 2024 net profit of just THB 40.27 million.
500% growth year over year.
500%. And this explosive growth also, naturally, boosted their earnings per share, or EPS, for 2025 up to THB 0.175. That's a significant leap from just THB 0.03 in 2024.
Huge jump in EPS.
Massive. And this dramatic surge, going back to your earlier point, wasn't primarily from selling vastly more product. Remember, revenue was flat. It seems to be driven by incredible operational efficiency and likely much better cost management.
Okay, margin improvement.
Exactly. Their EBITDA, which is a key measure of operational earnings before interest, tax, depreciation, amortization, that also roughly doubled. It reached THB 376.61 million for the full year, which is a 101.19% rise from 2024.
Okay.
This tells us they became far leaner, much more effective at converting their existing revenue into shareholder value. Their operations just became significantly more profitable.
Yeah. That's a really important distinction, that the profit surge wasn't mainly from a massive revenue jump, but really from improved margins and operational efficiency. That speaks volumes about management, potentially.
Okay, so
Now let's talk about valuation. How does AIE stack up on metrics like market cap, share price, and its price-to-earnings ratio? And what about Simply Waltz's fair value estimate? I know they often provide those.
right. When we look at AIE's valuation, it presents a particularly compelling and maybe even a bit perplexing case. Currently, its market capitalization stands around THB 1.6 billion. The share price, as of July 4, 2025, was THB 1.11.
Okay, 1.11.
Yep. Now, what's truly striking is Simply Waltz's discounted cash flow, or DCF, model estimate for AIE's fair value. Their model pegs the fair value at an astounding THB 21.06 per share.
21, but compared to 1.1.
Exactly, 2106. This indicates that, according to their model, AIE is trading significantly below fair value, which they define as more than 20% below. But in this case, it's by a massive, massive margin. It suggests it's deeply undervalued based on their projections of its future cash flows.
Okay, that's a massive difference. Almost, unbelievable. between the current share price and that estimated fair value. It sounds almost too good to be true.
It does raise eyebrows.
But the real insight here for you, the listener, isn't just that it's undervalued, perhaps, but why this significant disconnect might exist. What could be the reasons behind that gap, and maybe what specific catalysts might eventually bridge it?
You've absolutely hit on the core question there. A disconnect of this magnitude is, well, it's pretty rare, and it definitely demands a closer look. Why would a company with such strong recent profitability be trading so far below its calculated fair value?
Yeah.
One potential reason, which we'll touch on again later, is the lack of extensive analyst coverage. If major institutions aren't actively covering the stock, aren't providing consistent forecasts, the market might simply be missing the story. Or maybe there's a visibility gap that contributes to this undervaluation.
Okay, so less attention.
Possibly. Another factor could just be the broader market sentiment we discussed earlier. Investors might just be overly cautious about the time market as a whole, kind of overlooking strong individual performers within it.
Right, throwing the baby out with the bathwater, so to speak.
Could be. This disconnect, however, could represent a significant opportunity for astute investors, those who are willing to do their own deep dives. You have to understand that the market might just be slow to price in such rapid recent improvements, especially in a volatile climate like this.
So what could close that gap?
Well, catalysts to bridge this gap could include, obviously, sustained operational excellence, proving this wasn't just a one-year fluke. Increased investor awareness, maybe through better financial reporting or outreach, or even positive developments in the broader energy policy landscape that directly benefit AIE.
Okay, makes sense. So the undervaluation could be an opportunity for those willing to dig deeper. What about its price-to-earnings ratio, the PE? How does that compare to its competitors and the industry average? Does it support this undervalued thesis?
Yes, from a relative valuation perspective, AIE's PE ratio is quite favorable, and it does indeed support the undervaluation thesis. Based on its earnings of around THB 221.4 million and a market cap of about THB 1.55 billion, AIE's PE ratio stands at a pretty lean 7x.
7 times earnings. Okay.
Yeah, and this is generally considered good value when you compare it to its direct peers, which have an average PE of around 11.9x.
So significantly lower than peers.
Yeah. For example, some of its peers include AI itself, the parent, at 5.9x, UBE at 9.8x, Shiosco at 8x, and TAE way up at 23.8x. So AIE sits comfortably below that peer average.
Okay.
Furthermore, when you compare it to the broader Asian oil and gas industry, AIE's 7x PE is also good value against the industry average of about 11.2x.
Right.
So this low PE indicates that investors are essentially paying significantly less for each baht or dollar of AIE's earnings compared to its counterparts, which further reinforces the idea that the market might not be fully appreciating its current profitability.
Okay, so it's trading below its estimated fair value based on DCF, and it's got a lower PE than both its peers and the industry average. That certainly points towards it being potentially undervalued. But what about that analyst coverage you mentioned? Are a lot of analysts following AIE and providing forecasts, or is there a lack of institutional attention here?
This is where we encounter a bit of a data gap, and that might actually help explain some of that potential undervaluation. Simply Wall Street notes, and I quote, "Insufficient data to calculate AIE's price-to-earnings fair ratio for valuation analysis."
Okay, what's the fair PE ratio?
Right, so the fair PE ratio is basically an expected PE that tries to take into account the company's forecast earnings growth, its profit margins, and other risk factors. The fact that this calculation isn't available means one of the standard metrics for assessing relative value isn't readily there for a comprehensive comparison.
Got it.
And similarly, they report insufficient data to show price forecasts from analysts. While AIE is technically covered by 2 analysts, apparently 0 of those analysts actually submitted estimates for the inputs needed for Simply Walson's report.
So basically no active price targets being published widely?
It seems that way, at least not feeding into these aggregate platforms.
Yeah.
This means that while some might view AIE as significantly undervalued based on that DCF model and its PE relative to peers, there isn't really a broad analyst consensus or a clear price target providing external validation. So for you, the listener, this implies a greater need to, well, do your own homework, maybe exercise a bit more caution. You have to recognize that the broader market might not have a strong external signal on the stock's future direction, which means you need to rely more heavily on your own fundamental analysis.
That's a crucial point to highlight for our listeners that while the fundamental numbers look strong on the surface, the lack of broad analyst consensus might mean more independent research is required, but maybe also that's where the opportunity lies.
Could be. Exactly.
Now, let's tie this back to the dividend itself. AIE announced a substantial dividend payment for 2025. How does its recent financial performance directly support that payout, and what does it say about its sustainability, at least for now?
Yeah, this is where AIE's really remarkable financial health, at least for 2025, truly shines through. AIE announced a dividend payment of THB 0.25 per share for fiscal year 2025.
25 satang per share. Okay.
Exactly. And this substantial payout is directly and strongly supported by that incredible 500.80% surge in net profit we just discussed for the full year 2025.
Right, the earnings were definitely there.
Absolutely. The company's earnings increased so dramatically, they generated a significant surplus that can then be returned to shareholders. This indicates a very strong ability to fund shareholder returns from current earnings, rather than, say, needing to borrow or dip into reserves, which would be a red flag.
Sure.
So, for you, the listener, this means that the dividend announced for 2025 isn't just some hopeful projection. It's a direct reflection of a year of exceptionally strong operational performance and profitability. The sustainability, at least for this particular payout, looks pretty solid because it's clearly coming from a place of genuine, robust profit growth. It's not a situation where the company's paying out more than it earns.
That's quite a leap in profit, enabling that dividend. It truly highlights the operational successes for the year. But, a dividend, however generous, is really only as sustainable as the company's future earnings power.
Absolutely right.
So what about their long-term plans?
Understanding the forward strategy is vital. But actually, before we delve fully into AIE's operational outlook, it's probably worth just taking a moment to look at its relationship with its parent company.
That's a good transition. Yeah, it's interesting that both the parent and the subsidiaries seem to be performing well and paying out dividends. So let's turn our attention briefly to the parent company, Asian Insulators, or AI. How did AI perform financially in fiscal year 2025, and what was its dividend payout like?
Right, so AI, as the parent company, also showed a strong financial performance in fiscal year 2025, kind of echoing that positive trend we saw in its subsidiary, AIE. For the full year 2025, AI reported a net profit of THB 385.19 million.
Okay.
This marks a pretty significant increase from its 2024 net profit, which was THB 119.53 million.
Also a big jump then.
Yeah, substantial jump. And correspondingly, their earnings per share, or EPS, for 2025 rose to THB 0.55, up from THB 0.171 in 2024.
Okay.
And in line with this improved profitability, AI also announced a dividend payment of THB 0.19 per share for fiscal year 2025.
19 satang from AI. Okay, so both companies, parent and subsidiary, saw substantial profit growth and announced dividends. This suggests a pretty strong year for the group as a whole, doesn't it?
It certainly does.
How does this parent-subsidiary relationship between AI and AIE typically work? And what are the sort of deeper implications when both are performing so well simultaneously?
Yeah, the relationship between AI, Asian Insulators, and AIE, AI Energy, is actually quite crucial here.
Yeah.
AI is indeed the parent company, and it holds a substantial 75% stake in AI.
75%. Okay.
So this isn't just a corporate structure footnote. It really means AIE's stellar performance directly uplifts AI's consolidated earnings.
Right, it flows through.
It flows right through. And while AI's primary business is the manufacturing of electrical insulators, a completely different field, and AIE's is centered on biodiesel production and energy, it demonstrates a broader group strategy where even these diversified assets are being managed effectively for strong profitability.
Interesting diversification.
Yeah. And this kind of cross-pollination of success, where the subsidiary's operational triumphs flow directly into the parent's dividend-paying capacity, is a key reason why we often look at them together.
Makes sense.
When a parent company and its key subsidiary are both performing well and rewarding shareholders, it often indicates a stable and successful operational strategy across the board, and maybe a more resilient, diversified income stream for the group overall. It suggests that AI's leadership is effectively managing its portfolio of assets for overall shareholder value.
That's a great point about synergy and that diversified strength. It suggests the positive results aren't just isolated incidents. Okay, now let's dive deeper into the business strategy and the operational outlook for AI Energy specifically. What are their plans for biodiesel volume in the coming year, 2026, and how do government policies play into that?
Right. So AIE, being primarily in the biodiesel business, obviously has a very direct relationship with government energy policy. Looking ahead to 2026, AIE expects its biodiesel sales volume to be pretty similar to the previous year.
Okay, stable volume expected.
Yeah, that indicates a degree of stability in their core market, at least in terms of volume, which is somewhat reassuring. What's key here, however, is the government's expected policy influence.
Right.
The government is generally anticipated to maintain the B5 biodiesel blending policy. That means a 5% biodiesel content in diesel fuel as a baseline.
Okay, B5 maintained.
But more importantly, there's a strong expectation, or at least anticipation, that this blending ratio could increase to B7, meaning 7% biodiesel, starting perhaps from the second quarter of 2026.
An increase to B7.
Potentially. Now, this potential policy shift is likely contingent on the crude palm oil shortage situation easing up, because palm oil is the key feedstock for biodiesel in Thailand.
Got it.
But an increase to B7 would directly influence future demand and potentially pricing for AIE's product, likely positively, simply by expanding the mandatory market for their output. This is a significant potential tailwind for their future revenue, if it happens.
Okay, so stability in volume currently expected, but with a potential upside, a tailwind, from a policy shift to B7. That sounds like a managed growth strategy, maybe with a bit of potential policy help. How is AIE preparing for competition in this market? And what's their main focus to maintain profitability, especially if these policy changes maybe encourage more players to enter the field?
Yeah. Despite the stable volume outlook and those potential policy benefits, AIE is clearly not just resting on its laurels. They seem to be actively preparing for what they anticipate could be intensifying competition in the future, particularly if demand does increase with policy shifts like B7.
Makes sense.
Their key focus in this regard seems to be on continuous improvement in their production process efficiency.
Okay, efficiency focus.
Right, and this isn't just a buzzword. It implies really a deep dive into every step of their manufacturing, from sourcing palm oil, which is a key cost input that can be incredibly volatile,
Very volatile.
to the refining process itself and then distribution. They might be looking at things like new catalytic processes to convert the raw materials more efficiently, maybe implementing waste heat recovery systems to reduce their own energy consumption, or perhaps even leveraging advanced analytics and AI for things like predictive maintenance to minimize costly downtime.
Okay, getting lean.
Exactly. In a commodity business like biodiesel, being the most efficient producer, the one with the lowest operating costs, that's really your ultimate defense against price fluctuations and new entrants.
Right.
So by focusing relentlessly on these internal operational improvements, AIE is essentially building a more robust defense mechanism against future price pressures or increased competition. And this, in turn, is absolutely essential for the long-term sustainability of their earnings and, by extension, their ability to pay dividends. It demonstrates, I think, a fundamental understanding of their market and a strategic commitment to maintaining their financial health.
This emphasis on efficiency and adapting to policy changes really points to, as you say, a fundamental understanding of their market. It seems like they're not just reacting, but actively planning for the future. But let's broaden out again. What are the general risks associated with chasing high dividends, especially in this current climate? You know, when the market is uncertain, sometimes those high yields can be a bit of a red herring, maybe masking deeper problems.
That's such a critical question for any income-focused investor right now. And if we connect this back to the bigger picture, while high dividends are undeniably attractive, especially in a low-growth or volatile environment, they definitely come with certain considerations, particularly within Thailand's current economic and political climate. The primary overarching risk is just that persistent market volatility and uncertainty we talked about earlier. Despite the government remaining functionally operational for now, those domestic political risks, the court rulings, the potential for protests picking up, the challenges for the 2026 budget bill, they could indeed lead to policy vacuums or just further market jitters that disrupt the economy.
Right.
And then you add to that the global trade tensions, like the U.S. tariff situation, which could cause a broader economic slowdown. You just have a very complex risk environment overall.
Yeah.
And the SAE index's significant underperformance this year is really a clear reflection of these uncertainties already being priced into the market to some extent.
So even with a functional government, those underlying political currents are a definite concern that could ripple through the economy. What about the dividends themselves? Is there a risk that a high yield could actually be a yield trap rather than a genuine sign of strength?
That's a critical point to consider for you, the listener. A high dividend yield can sometimes be quite deceptive, and this is exactly what we call a yield trap.
Okay.
It might be a sign simply of a falling stock price rather than genuine, robust company performance. The stock price drops, making the existing dividend yield look artificially high, but the underlying business might actually be deteriorating, making the future of that dividend very uncertain.
Ah, okay. So the yield looks good because the price went down, not because the company's doing great.
Precisely. And while AI and AIE have shown strong recent profit growth, which is definitely a positive indicator, the general principle still holds true. Past dividends never ever guarantee future payouts.
Right.
Companies might be forced to cut or even suspend dividends entirely if their financial health deteriorates significantly. Or even if they just decide to retain earnings for critical investments or maybe debt reduction, which might actually be in the company's long-term best interest, but would impact short-term shareholder returns.
Yeah.
So even with strong recent performance like AIE's, the broader economic and political risk we discussed could still impact future profitability and consequently dividend sustainability down the road. It's like, checking the foundation of a house that looks beautiful from the outside.
Yeah.
You wouldn't buy it just for the fresh coat of paint, would you? The dividend is kind of like the paint. The underlying earnings and cash flow are the foundation. You need both.
That's a great analogy. And speaking of broader economic risks, you mentioned earlier the potential for Thailand to enter a technical recession. How would that likely impact corporate earnings and dividend payouts across the board, not just for AI or AIE, but more generally?
Yeah, a technical recession, as warned by Tisco, possibly in the second half of 2025, driven by both those domestic and external pressures. That would undoubtedly impact corporate earnings across virtually all sectors.
Right, it's systemic.
It is. When the economy contracts, consumer spending typically slows down, business investments often get put on hold, and overall demand just weakens. This directly translates into lower revenues and probably compressed profit margins for most companies.
Okay.
So if corporate earnings are broadly affected, even fundamentally strong companies might face pressures on their cash flow. And that could lead to potential reductions in dividend payouts across the market. While some sectors or specific companies might be more resilient than others, a recession just creates a really challenging environment for everyone.
Yeah.
It introduces a systemic risk that you absolutely must factor into your investment decisions, regardless of how attractive a single company's dividend might look in isolation. It could force even good companies to prioritize cash preservation over shareholder payouts, even those with strong recent performance like AIE.
That makes perfect sense. So investors really need to be mindful of the macro environment. Now, going back specifically to AIE, you mentioned that lack of broad analyst coverage and published price targets. What are the practical implications of that for an investor who's looking at its potentially high dividend?
Right. The absence of that consensus analyst price target for AIE and the insufficient data to calculate its fair PE ratio on platforms like Simply Walsane, it introduces a particular kind of risk, or at least a different dynamic, for investors.
Okay.
It means that the external validation, that sort of comfort blanket that many investors rely on for guidance, just isn't readily available.
Right, less third-party confirmation.
Exactly.
Yeah.
Investors are then required to rely much more heavily on their own fundamental analysis, their own homework. While the Simply Walsane DCF model might suggest it's significantly below fair value, and its actual PE looks favorable compared to peers, the lack of widespread analyst coverage can increase the perceived risk for some investors. It means there's less independent research out there publicly scrutinizing the company's prospects, forecasting its future earnings. And that could make it harder for the market as a whole to fully appreciate or price in its true value, contributing to that potential undervaluation we discussed.
Okay.
So for you, the listener, it really just implies a greater need to roll up your sleeves, do your own digging, and perhaps exercise a bit more caution, recognizing that the broader market might not have a strong external signal pointing the way on this particular stock's future direction.
Yeah.
This isn't necessarily a deal breaker, of course, but it certainly shifts the burden of that deep analysis more onto the individual investor.
Okay, so we've got this low PE, this massive potential fair value discount based on DCF, strong recent earnings. It almost sounds, a bit too good to be true sometimes.
You can feel that way.
For our listeners who are maybe seasoned investors, what's the potential bear case here? What's the hidden risk they should be thinking about that isn't immediately apparent just from these numbers beyond the general market risks we've covered?
That's a really thoughtful question, and it's essential to always consider the potential downsides. So, Beyond the broader market and political risks, a potential bear case for AIE, despite its stellar recent performance, might center on the inherent volatility of commodity markets themselves.
Ah, the underlying commodity.
Exactly. Biodiesel production relies very heavily on crude palm oil prices, and those prices can fluctuate wildly due to things like weather patterns affecting harvests, geopolitical events disrupting supply chains, or even just changes in agricultural policies in major producing countries.
Right.
Now, while AIE is focused on efficiency, a sharp, prolonged spike in those feedstock costs, if it couldn't be fully offset by, say, government blending mandates pushing up selling prices or their own cost controls, well, that could significantly compress their future margins and impact their ability to sustain the current dividend levels.
Okay, so feedstock price risk is key.
Definitely. Another less obvious risk could be around regulatory changes. While we expect, or hope for, B7 blending, future governments or maybe shifts in environmental priorities could potentially alter the demand landscape for biofuels altogether. They might favor other energy sources or different blending types. This could introduce a kind of structural headwind for the entire industry, irrespective of how efficient AIE is operationally.
Policy risk beyond just the blending percentage.
Yeah. So while efficiency is absolutely key for them, these external factors, commodity prices and policy, can always play a potentially disruptive role.
This raises, I think, a really important question. How do we as investors distinguish between a genuinely stable, high-dividend stock and one that might be a riskier bet, a potential yield trap? How does a company's dividend policy really tie into its overall financial health, and what should we as listeners look for as clues?
This is truly the crux of identifying sustainable high-dividend opportunities, isn't it? It's not just about the yield percentage flashing on your screen, but understanding the underlying policy and the financial stability that supports it.
Right.
Let's maybe look at the general principles that guide dividend payouts. Often you'll see companies, maybe like Asia Sermkids Leasing, ASK, is often cited as a good example of having a transparent policy. Many companies aim to declare dividends at what they call an appropriate rate.
Okay.
Often this falls within a specific target range, say between 40% and 70% of their payable net profit for the year.
A payout ratio target.
Exactly, a payout ratio target. And this policy isn't just arbitrary, it's usually a deliberate financial strategy. And importantly, it's subject to several crucial factors. Things like the company's actual performance, its current financial standing, like its debt levels,
Right.
the prevailing economic conditions, obviously compliance with relevant laws and its own articles of association, and critically, its ability to fulfill all its other obligations, things like debt repayments or necessary capital expenditures for future growth.
So it's not just about having profit, it's about the company's overall financial health and all its commitments. Are there any absolute rules that might prevent a company from paying a dividend, even if it technically had a profitable year?
Yes, absolutely. There are fundamental rules that are really paramount for protecting the company's long-term viability and its creditors. Crucially, no dividend can normally be paid from monies other than profit. A company can't just dip into its core capital to pay a dividend, as that would essentially erode its very foundation.
Okay, can't pay out capital.
Right. And just as important, if a company incurs accumulated losses on its balance sheet, it is typically prohibited by law from paying any dividend until those past losses are fully covered by subsequent profits.
Makes sense. Have to clear the red first.
Exactly. Now, companies might also pay interim dividends during the year if their profits are deemed adequate mid-year, and they'll usually report this to shareholders in the next meeting. This can provide more frequent returns for investors.
Okay.
And what's more, while a company's board of directors can amend its dividend policy, typically, such significant changes are meant to be made for the shareholders' best overall interest and often require approval from a shareholders' meeting. This provides a layer of oversight and ensures transparency, which is vital for investor confidence.
That brings us back neatly to AIE and AI.
Yeah.
We saw those huge profit surges for them in 2025. How do those general principles of dividend payouts connect specifically to AIE and AI's financial stability and their likely ability to sustain those dividends going forward, given these kinds of policies?
Yeah, this is where AIE and AI's really strong 2025 performance becomes highly significant in the context of these principles. AIE's truly remarkable 500% profit surge and AI's substantial profit increase as well, they directly underpin the dividends they announced for 2025.
Right.
This isn't a scenario where they're stretching, paying out more than they earned, or paying dividends despite having accumulated losses. Their dividends are clearly backed by robust operational performance and genuine, significant profitability in that year.
Okay.
And that is a crucial distinction between a potentially sustainable dividend and a potential yield trap. Furthermore, AIE's stated focus on continuous improvement in production efficiency to control costs. That's a clear strategic move designed specifically to maintain its financial stability and profitability into the future.
Right, protect the margins.
Exactly. This proactive cost management is absolutely vital for ensuring that there's likely to be a consistent stream of earnings available to support future dividend payouts, even if they face a more competitive market. It really shows a commitment, I think, to maintaining the profitability that underpins their dividend policy.
That makes AIE's dividend look, well, much more secure, at least based on that recent performance and strategy. And you also mentioned earlier that AIE's PE ratio is favorable compared to its peers and the industry, despite its current low share price relative to that high DCF fair value estimate. What does that specifically imply about its financial health and the security of its dividend?
Well, it implies that the market might not yet be fully appreciating AIE's underlying financial strength. When a company's PE ratio is lower than its peers and the industry average, especially when coupled with strong recent earnings growth and a high estimated fair value from something like a DCF model, it can be a strong signal that the company is undervalued. This favorable PE, despite its currently low share price relative to that potential fair value, suggests that its financial health might indeed be stronger than what its market price currently reflects.
Interesting disconnect.
It is. And this scenario can make its dividend potentially more secure simply because the company appears to have solid earnings power relative to its market valuation to back those payouts.
Right.
For you, the investor, it's a key indicator to look beyond just the headline yield number and really delve into the company's core earnings power and how efficiently it's actually run. Those are the true drivers of sustainable dividends over the long term. It indicates that the market might just be mispricing its current performance and future potential relative to its peers right now.
Okay, so to summarize for our listener then, why does understanding all these nuances about dividend policy, financial stability, payout ratios, why does it truly matter to them when they're making investment decisions? What's the real practical takeaway for them?
For you, the investor, understanding the source of a dividend is absolutely critical. Where is that cash actually coming from? Is it coming from genuine, sustained profit generated by the core business? Or is it maybe from a temporary gain, like selling an asset? Is the company generating enough cash flow consistently to cover its operations, its necessary investments for the future, and still comfortably pay a dividend?
Right.
This kind of deep dives into a company's financials helps you differentiate between a healthy, sustainable dividend payer and one that might be skating on thin ice, a potential yield trap.
Yeah.
Furthermore, a company's stated dividend policy, like that 40–70% payout range we discussed as an example, it really reflects management's own outlook on future earnings and its capital allocation priorities.
What they plan to do with profits.
Exactly. How much are they reinvesting for growth versus returning to shareholders? A consistent, clearly communicated policy can signal stability and predictability, which are often highly valued by income investors. It tells you how management intends to balance those two things. So it's not just about receiving the cash today. It's about understanding the health of the underlying business that delivers that cash and the likelihood of it continuing to do so in the future.
We've really uncovered some fascinating layers here, haven't we? About the intersection of individual company fundamentals and the broader market context. So just to recap, we looked closely at AI and AIE. We saw the truly strong profit surges in 2025, which directly led to those significant dividend announcements. AIE, in particular, seems to be in a compelling position, appearing potentially undervalued based on its DCF model from Simply Walson and those favorable PE ratios compared to its peers in industry, despite the gloomy overall market sentiment.
Right.
We also saw their forward-looking strategies, focusing heavily on production efficiency and actively adapting to potential policy changes in the biodiesel sector. And all of this is playing out against the backdrop of a broader set-time market, where high dividend stocks are actually being recommended by analysts as a strategic play amidst the ongoing volatility and those political and economic uncertainties. It's definitely a complex picture, but maybe with some clear signals there for the discerning investor.
I think that's right. This deep dive into AI and AIE really highlights that even in a challenging market environment like Thailand's right now, there are indeed companies demonstrating robust financial performance that can directly translate into shareholder value through dividends. The critical takeaway for you, our listener, is really to always look beyond that headline dividend yield number.
Yeah, dig deeper.
You absolutely must investigate the underlying profitability, scrutinize the company's strategic outlook, understand where the cash for that dividend is coming from. You need to ask, are these companies merely attractive on the surface? Or are they truly backed by solid fundamentals and a forward-thinking management team that can realistically sustain those payouts, even in the face of ongoing market pressures?
Yeah.
That's the real million-dollar question.
Mm.
And maybe a final thought to leave you with. Considering those ongoing policy discussions around biodiesel blending, like the potential move to B7 and AIE's stated commitment to efficiency, how might future government energy policies either further cement or perhaps challenge AI Energy's market position and, by extension, its dividend sustainability in the years to come?
A truly thought-provoking question to leave us with, indeed. Okay, that's all the time we have for this deep dive. Thank you so much for joining us.
Thanks, everyone.
And if there's a specific stock, maybe a sector, or even a different market you'd like us to feature next, please just let us know. Your insights really do guide our next deep dive. We'll see you next time.